Have you ever noticed how most people don't buy things with money anymore? They buy them with monthly payments. Not the house, not the car, not even the phone, just the payment. And that small shift in thinking quietly changes everything. Let's imagine someone typical. Daniel is 29. He lives in Texas. He earns $82,000 a year. After federal taxes, state taxes, Social Security, Medicare, and health insurance, he takes home about $5,200 a month. That sounds solid. Upper middle class on paper. Now let's look at reality. Rent, $1,900, car payment, $540, car insurance, $180, student loan, $420, groceries, $500, utilities plus internet, $250, phone subscription, $120, gas, $200, credit card minimums, $300. We're already at around $4,410. That leaves roughly $790. From that, he eats out, he travels occasionally, he buys clothes, birthdays, weddings, emergencies. By the end of the month, there's almost nothing left. And yet Daniel feels like he's doing well, because compared to his college years, he is. Now here's the uncomfortable question. If he needed a loan for the car, did he actually afford the car? Or did he afford the payment? The modern financial system doesn't sell products. It sells affordability through financing. A $38,000 car sounds expensive, but $540 a month? That sounds manageable. Add interest over 6 years, and that car may actually cost $45,000. But psychologically, the brain doesn't process $45,000. It processes, can I handle $540? This is the hidden mistake. We measure lifestyle by monthly pressure, not by total cost or opportunity cost. Let's do simple math. If Daniel invested $540 a month instead, earning a modest 7% annually, over 10 years, that grows to around $93,000. That's just the car payment, not including insurance, higher maintenance, registration, or the opportunity cost of tying up cash. The real cost of the car isn't $45,000. It's closer to $90,000 when you factor in lost compounding. And that's just one decision. So why do smart people still do this? It's not stupidity, it's identity. In the US and much of Europe, lifestyle is social proof. The car signals progress. The apartment signals stability. The vacations signal success. We are wired to avoid feeling behind, especially in your late 20s and early 30s when everyone seems to be upgrading at once. The pressure isn't loud, it's subtle. You see friends moving into nicer neighborhoods, colleagues leasing newer cars, social media quietly redefining normal. And because your salary increased, your brain tells you your lifestyle should increase too. This is lifestyle inflation, and it feels earned. But here's the system flaw. Your income grows linearly. Your expenses compound. Loans lock in future income before you even earn it. Every EMI is a claim on your future time. And once enough of those claims stack up, you're no longer working to build wealth. You're working to maintain a standard. That's why so many professionals earning $80,000, $100,000, even $150,000 still feel financially tight. Not because they don't earn enough, but because they've pre-spent too much. Now imagine someone else. Same salary, same city, but different thinking. Instead of asking, can I afford the monthly payment? They ask, would I buy this if loans didn't exist? That question changes behavior. If financing disappeared tomorrow, many lifestyle upgrades would disappear with it. Financially intelligent people don't avoid loans entirely. They just understand what loans are. They're not tools for lifestyle expansion. They're leverage, used carefully, rarely, and intentionally. A mortgage on a reasonably priced home can make sense. A business loan can make sense. A depreciating car stretched over 6 years to maintain an image usually doesn't. The difference isn't income, it's restraint. And restraint doesn't feel exciting in your 20s, but it compounds powerfully in your 40s. If Daniel continues his current pattern for 15 years, he'll likely upgrade the car again, move into a bigger place, increase spending as income rises. He won't feel reckless, he'll feel normal. But at 45, he may have very little invested relative to what he earned. Not broke, just dependent on the next paycheck. On the other hand, if he redirects even a portion of those lifestyle payments into investments consistently, the gap becomes dramatic over time. Not because of extreme frugality, but because of math. Wealth isn't built by dramatic financial hacks. It's built by controlling fixed obligations. Once your mandatory monthly payments are low, your flexibility increases. Flexibility is underrated wealth. The real message isn't never borrow. It's this: if you need the the loan to sustain the lifestyle is ahead of your wealth, and living ahead of your wealth feels good short-term, but fragile long-term. There's nothing wrong with enjoying your income, but clarity matters. Are you buying freedom or are you buying pressure? Most people never pause to ask. If this made you think a little differently about your own numbers, consider subscribing.